Welcome to Theo Trade. This is Don Kaufman. Here we are doing the weekend update. It's July 23rd, 2016. Let's kick it off with this. The grind to the upside continues inside of the S&P 500. But this week we really saw a tremendous number of earnings announcements, and those earnings announcements drove a vast number of emails. So what we're going to do is we're going to talk a little bit about some of the earnings announcements, and more appropriately, many of you tuning into this, you might not necessarily want to trade the earnings announcements, but I'm going to show you some interesting stuff that, again, might get you thinking a little bit differently about those earnings announcements here in what is an utterly low implied volatility marketplace. Let's start by looking at Netflix, because after Netflix earnings this past week, I was literally bombarded with emails as I made a statement prior to the earnings announcement. And many of you guys probably heard this, but the statement was along the lines of, do not in any way, shape, or form sell options around Netflix's earnings announcement. So, of course, I get bombarded with emails, and everybody said, well, how did you possibly know that Netflix was going to move outside of the expected? And what that basically is every time we look at an earnings announcement, we look at something called expected move. It's the EM, okay? And in this example, say the expected move is plus or minus, for instance, $10. Now, all that's ultimately based on, okay, is what we call a log normal distribution curve. Right? Log normal just means the stock can only go to zero, but it's a normal distribution curve. And what that means is Netflix prior to the earnings is likely to go up $10 or down $10, right? And stay in that range, an appropriate, what we call 68.3% of the time, which is one standard deviation. Now, this is something that we talk about fairly extensively here. We can build trades around what's termed the expected move for earnings. However, if you heard me earlier in the week, I kept barking, don't do it! Don't do it! Don't even think about do it! Don't even think about not doing it! Just do not sell options around Netflix. So I want to point this out. If you went into Netflix, yes, Netflix, it had its earnings this week. Okay, and we'll go right back to the day prior to the earnings over there, which was 7/18. So I'm going to go on Thinkorswim to the Analyze tab, and I'm going to go to what's called Think Back, okay? Close up this left side bar. We don't need no stinking left side bar, and this is going to be, well, either eye-opening or awe-inspiring to you, but you can go back just a few days. Let's go back to that fateful Monday. And again, the blanket statement that always comes out, implied volatility is high, right? So let me highlight the implied volatility over here. And well, Don, implied volatility is high. And the expected move is right there. It's about $9.50. So it's saying Netflix is going to move up or down, again, about $9.50. And that's with Netflix trading just shy. There it is. And the day before the earnings, this is right before the earnings, it closed at 98.81. Okay. Obviously, I'm screaming, don't sell options, don't sell options, don't sell options. Okay. Fast forward one day, the stock moves almost $13. In fact, we even went out and we bought an option strategy around that. Okay. Well, how could you possibly know? Well, at Theo Trade, we do know. We actually built technology for this, and we've been looking at it and beta testing some of the technology. The technology was in alpha mode until this week. We are now moving into full beta mode. And what I'm getting at with this is this, okay? All of these models that we're using, okay, in today's marketplace are based on what is termed, again, a normal or log normal distribution curve. And you don't have to be a geek to get into this. So everything you're kind of doing in the options market is based off of one of these. So we put together a development team, and we wanted to see, is that true? Okay. Is it true? Do markets always follow a log normal distribution curve? In a lot of underlyings, the answer was yes. In some underlyings, the answer was absolutely not. Let me show you. In Netflix, okay, if you ran historical data on Netflix, what you're going to find out is it is anything but a normal distribution curve. And what that means is the number of times that, Netflix goes way up here versus way down there, is that equivalent? Okay. Does it actually fall within this zone much more than out here? Well, I'm going to let you guys be the judge of that. This will be the first time we've ever displayed anything along this lines. Okay. We're moving into kind of next generation probability analysis. And this is what we call theoretical versus historical probability distribution chart. And you're like, what? Okay. Well, everybody talks a big game when it comes to probabilities and options. Well, now we're actually going to be able to show you, historically speaking, what products are really moving in what we term, again, a log normal distribution, and what products don't look anything like a log normal distribution. Okay? Netflix is one of the products that should scare you. The tool that I'm showing you right now is going to be available on the TheoTrade site the coming days, the coming weeks. We are in, again, the infancy of a beta mode. All the data that you're seeing over here, what is it? Okay? What we're looking at is 5 years, okay, of historical data in terms of how much did Netflix really move? Not around just earnings announcements, just period. How much did it move? Did it move up a massive amount? If you look far to the right-hand side of the screen, all right. In fact, I'll even kind of mark it on the screen. I'm talking about that bar right there. You know what that is? Okay, that's a bar that, statistically speaking, should never happen. It's like 4 deviations outside. All right. And again, you don't have to be a total technology geek. At a quick glance over here, what it's telling you is, oh my, we don't ever want to sell options inside of something like Netflix. Now, again, does that make you want to be a buyer of options? Well, some of the technology in here can help you there as well. Everybody's like, it's an efficient marketplace. All right. What we're doing, though, in this particular context is we're getting away from just theoretical option modeling. And theoretical just says that, hey, it's a blanket statement over here, and theoretical says that everything is just based off of one of those, right? A normal distribution curve. In fact, there's nothing wrong with trading on this notion. In fact, one of the key tools in Thinkorswim, this is, all right, a log normal distribution curve. It's just flipped on its side, right? This is exactly what I'm talking about. But what happens if you had data, okay, based on previous moves in Netflix and knew that Netflix didn't really make normal moves, that Netflix was actually capable of these 4 and 5 sigma events, which is, for those of you that don't speak geek, it doesn't look like a normal distribution curve. All right? The distribution curve in Netflix may be drastically skewed. All we're trying to do, okay, is elaborate upon and display that kind of data. In addition to it, we threw in some fun stuff like statistical volatility for 400 days, or for 300 days, or for 200 days, over 100 days, whether you're a short-term trader, whether you're a long-term trader. You don't even have to run 5-year data. You could just run it over the last 1 year. What is that data going to look like? Does that even look like a normal distribution curve? Yes. No, it does not. It doesn't look anything like it. All right. And I'm picking on Netflix because that's one of the prime time. But maybe you don't want to use Netflix. Maybe you want to go in there and type in something like the spiders. Okay. Why not the spiders? Does that really look somewhat like that? And by the way, there's all kinds of fun tools built in here. Theoretical versus historical probability, theoretical versus historical probability distribution. We're going to look at this over a 1-year time frame now. This is 1 year, okay, of returns in the spiders, the S&P. And you'll see, all right, that looks a little bit more log normal. All right, let's look over the last 5 years and see what it actually says. And again, you can start to get a feel. You can start to get a feel for, are theoretical probabilities effective in certain underlyings, where in other underlyings, using historical probability is going to be much more effective. Here in the spiders, what you'll actually find out in the spiders, pretty interesting, just at a glance, And I'll be able to talk you guys through this, but at a glance, what you're actually seeing is here is, and again, this curve, that's the theoretical probability. Right here is the actual probability that the skewness of the market over the last 5 years is to the upside, which actually tells you that, well, more bullish strategies would have worked. That's actually not exactly what it's telling you. Yes, the returns are skewed to the positive side, but you would expect that. It is the S&P 500. What we're actually looking for is, do these odd anomaly events occur? And if you look way out here, okay, on the left-hand side of this curve, there was a wild anomaly, even over the last 5 years inside of the marketplace. So we're going to start looking for opportunities in marketplaces, okay, where others don't necessarily have the technology to do that. And that's really one of the areas that we're starting to kind of build out at TheoTrade. So we're no longer just going out there talking about markets, teaching about markets. Now we're actually building technology specifically to make you more effective in those markets. Again, what we build, we will fully explain. We will have a version of this available to everybody, okay, inside of the coming days on the TheoTrade site. So stay tuned. Much more to come on this front. As far as this week of trading over here, back over to Thinkorswim. This week of trading, what should you expect? Well, that's where we go to the SPX and we look incredibly low implied volatility. The entire week is only expecting a $23 expected move. Once again, I will state, be careful if you sell option premium in this. The actual moves are exceeding, all right, most of the implied volatility. What that basically means, again, is you don't want to be an option premium seller in some of the short duration out there. And that's exactly what our technology has been kind of deciphering over the last couple of weeks. And that's why we've been barking about don't sell options in this underlying, possibly buy options in this underlying. And again, much more to come on the technology front. Thanks everybody for joining us here for the weekend update at TheoTrade. We're going to be back in our chat room all throughout the course of this week. Have a great weekend. Bye-bye.